Welcome back. You're watching The Money Show on ET Now. And of course, the topic's got to be on Budget 2020. And a lot of you watching, while you've now, hopefully, thanks to watching The Money Show, got a gist of what the implications of the tax norms are going to be on your tax bills. It brings about now the other questions with respect to savings, with respect to retirement, and also for your mutual fund portfolio. Because do note, ladies and gentlemen, in the fine print, we had several other announcements which the FM did not speak out during her speech. One of them being that now you cannot put more than 7.5 lakh rupees. The employer cannot put more than 7.5 lakh rupees in various retirement schemes, or it will be taxable. Also, the new regime is for those people who don't have PPF, who don't have ELSS, etc. So various other investment schemes will not be allowed to be claimed as an exemption in the new regime. And of course, finally, I'm sure a lot of you may be wondering that, hey, does this budget really make a difference to my mutual fund portfolio, which I've been investing in, which I've been doing my SIPs in for various goals, like, for example, for my child's education, or, you know, for my future safety and security, or for general wealth creation? Well, we'll get all of that answered with Uday Dhoot of Venn Wealth. He joins us right now on the show. Uday, thanks so much for joining us on The Money Show. I just want to start off by talking about a direct provision that was introduced in Budget 2020, and that is that, look, you get a new tax slab, but in this new tax slab, you obviously cannot take any exemption. So what essentially the finance minister is saying is that for all those individuals, you know, who don't have enough money to put in all these tax saving investments like PPF and ELSS, you can just get an instant gratification of sorts, because here you go, I'm allowing you to claim these lower tax slabs. But Uday, instant gratification by giving up future savings, is that the right way to do so there? Wouldn't you rather have people put their money in PPF, put their money in ELSS, and maybe, okay, have to pay that higher rate? Wouldn't that still be a better option than just going in for that immediate savings that you're getting by paying lower taxes?
So Mubina, you have sort of hit the nail right at the head, and you've sort of raised a very important question here, saying that between the selection of whether one sticks with the old regime or moves to the new regime is the question of tax savings. So let's look at one person who is generally disciplined, and he kind of planned himself or herself well, knows how much he needs to save, and does all of this correctly, as one should, and sort of takes care of his financials accordingly. Now, we know that a lot of us lack that financial discipline, especially when it comes to thinking long term. World over, there is a lot of research around people finding it very difficult to think about retirement, to think really long term investing. People think it's very hard to think about, for a healthy person to think about bad health and why one should buy health insurance, and likewise for life insurance. So my basic argument here is that these are slightly difficult behavior pieces to solve for. Though the right thing is buy term insurance, buy health insurance, save regularly for the long term. But behaviorally, these are difficult things for us to do. Tax saving was a great way to induce people to do things which were right for them. And obviously it starts with small amount of savings, that 1.5 lakh rupees may not be sufficient, 1.5 lakh rupees of ATC and plus the other tax benefit may not be sufficient to take care of everything, but it's a good starter for everyone, especially when somebody is taking up a new job. It's a good way to sort of get him to the habit of saving, if I just think of it from a behavior perspective. Once you sort of remove this, so obviously from a government perspective, from an FM perspective, right now there is maybe more impetus to sort of consumption and spending, not so much to savings. But I think when I'm thinking from a younger person, from a millennials who's coming into job for the first time, the tax saving brings in a good habit of saving, which may not sort of come in automatically otherwise. So I would kind of find it difficult that maybe for a lot of us it would be better off. I'm not talking about financial gains here. I'm not even comparing whether you are better off under the new tax regime or the old tax regime. That's not the point here. The point is that am I getting into a habit of saving regularly and taking certain difficult decisions which are otherwise not so easy? right? So that's the point I'm getting at, and I think maybe for a lot of us the old tax regime from that perspective might be a better thing for youngsters who are not necessarily thinking about all these issues. Maybe just sticking to the old regime, taking the tax benefits, this would be fine. Then there is this one category of people who are genuinely, for some reason or the other, not able to save money to take full advantage of the ATC sort of benefits. Maybe for that one small lot of people who are under circumstances where they're not able to save sufficiently, move to a lower tax regime, at least you get that additional tax benefit. But the point is that importantly for most of us, it is getting into a regular savings habit that is very, very critical to sort of bring about, apart from the tax savings that you do.
Yeah, mind you, folks, we are not talking about the actual savings you will make. I mean, if you switch to the new regime from the existing regime, we're just talking about that basic savings habit, which came about by force because of this, these tax exemptions and deductions that we were allowed to get. It may be forcibly, but at least, at the end of the year, you're saving up a good amount of money. You're getting maybe your PPF interest, or in ELSS cases, of course, which is subject to market conditions. But, there is money being saved somewhere for your future years, for your years in silver. We're not talking about how much you're saving. But of course, mind you, folks, even if you still want to go ahead and make all of those PPF and ELSS investments, and you'll still want to opt for the lower tax regime, you just cannot claim the deductions. But nobody is stopping you from making those PPF investments. But I suppose that people will not do it unless the government tells them, look, you've got to do it, and only then I'll give you a tax savings. I suppose that was a good threat of sorts to, get people's mindset going to investing in such small saving schemes. Okay. Uday, now I want to talk to you about essentially retirement, because there have been some changes over there as well. Will Budget 2020 impact my retirement corpus? Will it impact the way I save for my retirement? That's what I would like to understand. Uday?
So, like when you're talking about retirement, right? So, the important point about retirement is that how does the current budget sort of impact the retirement? Now, if you remember that pretty much for all salaried folks, there is the PF deductions that is pretty much compulsory. And over and above the PF deduction, over the course of last few years, government really wanted to create a more beneficial sort of environment around the NPS, which meant that NPS had tax benefits under multiple different sections of the Income Tax Act. And one of those sections allowed salaried folks who had money directly paid from their side, directly deducted from their salary and contributed to the NPS, they could take almost up to 10% of their basic with no limits as a tax benefit. Now, suddenly that sort of goes away because we have this 7.5 lakh rupees sort of overall limit that is sort of coming on top of that. So I don't know whether it will force people to think about retirement or no, but as we know that when it was tax and retirement together, it sort of made the decision easy for investors, for a lot of people, because they saw that, hey, I can additionally save that extra tax, so why not let me take this up? And by virtue of the NPS product or the EPF, they were long-term products, right? You could not sort of just take out the money. So I think maybe there might be slight dent, because people might think that let me just take out this money and maybe let me plan this. I have, from my own experience, seen many a time when we look at clients' portfolio, suddenly some expense comes up and they will tell you saying that, hey, just give me this money right now, and in the next 3 months I will sort of put this back in. And we have seen that that money many times does not come back, which is why it is important to segregate these in specific goals and sort of take them away from you, right? And I think somewhere here we are missing a few tricks from an income tax standpoint of view, overall larger sort of social sort of structure that we want to build. And unlike other developed markets, India is not necessarily does not have a safety net for people. If you fall sick, you need to basically get treated by yourself, so you need to have sufficient covers for yourself. Likewise, for your retirement, there is really nothing from coming to you post retirement. You need to plan for your own retirement. So I think given that environment, maybe there is more nudge required towards making these decisions for people versus sort of taking them away. I hope this is an aberration. As we move forward in the coming budgets, this sort of aberration is corrected, and it is important that it is corrected to ensure that people actually think about retirement, which is one of the largest issue today a developed country faces, that people are not saving enough for retirement.
And India does not even have those social security schemes that maybe a United States or, the United Kingdom offers. It's each one to his own, you could call it that. Yes, you do have the Provident Fund, which the employer essentially, puts away from your salary. But what about the guys in, small businesses, small traders? These are some of the few avenues available for them for retirement. Okay, well, let me move on to mutual funds. And by the way, on that note, let me inform our viewers, if you have any questions or queries on your personal finances and how Budget 2020 could change that, you can always call in. The numbers appearing on the top of your screens. But yeah, with respect to mutual funds as well, there was a key announcement that that's the dividend that our mutual fund holders earn if they've opted for the dividend option. So, Uday, is that going to leave our dividend mutual fund holders richer, poorer, or just the same?
I was just listening to the show before this, and we spoke about saying that how the tax rate at around 20% for dividend earlier was there, which was taken at the source level. Now, essentially, I have to pay the tax at my level as an individual. So anyone who is above 20% tax slab, it does not make sense to stay in the dividend option of the mutual funds. You are better off moving into the growth option and sort of making those investments, basically creating the cash flow by yourself, maybe either through SWP kind of a method, but dividend option does not make sense anymore for people who are above the 20% tax bracket.
Okay, so is there anything in this budget 2020 that long-term mutual fund investors should be wary of? Is there any what we call devil in the details as such in budget 2020 that MF investors should be wary of?
Actually, nothing. I think barring this dividend option piece that has sort of come up, I don't think there is really anything else to be wary of. One other thing that sort of came up, which possibly is a positive, is that some time back we had this whole rule around segregation of basically investments in debt funds which have gone below investment grade could be segregated into a separate sort of a fund. There, at least now you have the option. Earlier those were issued as bonus, and you sort of ended up, whenever that money got received, there were chances that you would end up paying short-term capital gains tax on that. But now you have an option of sort of showing your purchase date as the original purchase date. So that's actually a beneficial thing for investors from an MF perspective. Glad that got clarified. There are some rumors around capital gains, TDS on capital gains. I don't think that is applicable as such for capital gains on mutual funds. It is only on dividends and not on capital gains. Apart from that, the only other piece that I would like to say to all investors here is that now we were some time back at a stage wherein equity mutual funds taxation was exempt. Debt was 1 year used to become long term, and now suddenly debt mutual funds, and this has already happened 2 years back, wherein now debt mutual funds you have to hold for 3 years before it becomes long term and you get the preferential tax treatment. I think the point for most investors is that when you are planning your mutual fund portfolio, build a well diversified portfolio and avoid too much churning in the portfolio. Too much churning will only increase your tax cost in the portfolio, which over the long period of time will reduce the return. So basically think through what you really want to achieve from your investments, plan your portfolio accordingly, and reduce the churn in your portfolio as much as you can.
Okay, so basically speaking, Uday, for long-term investors who are essentially saving for their retirement, I suppose the one change you'd recommend them to make is that if any of them are in the dividend option, especially if you're in the higher tax slab, that's 20% and above, it makes sense that you just switch over to the growth option. And any which ways, folks, we always say that having a growth option is always a more tax-efficient option, and it will eventually give you better returns as well over the long term, especially if you're a long-term investor. And secondly, Uday, for long-term investors, I suppose if you're going to invest for the next 9-10 years, which should ideally be your excuse me, time horizon, you're going to see 9 to 10 union budgets, and I suppose you just have to ride through all of them. Just be patient, keep your goal in mind, and just have a sound investment strategy in place. Be patient and consistent with your SIPs. Okay, Uday, just a quick, let me just also tell our viewers again that you can send in any questions or queries you may be having. And by the way, we already got our first query from Mr. Ajit from Bangalore. He asks that in the case of equity mutual funds with growth option, will mutual funds have to pay income tax on the dividends received by them from the stocks in which they have invested? If yes, what will be the income tax rate? Okay, so that's a very important question, actually, a very basic question, because as we know, mutual funds invest in companies, and these companies obviously pay dividends to all shareholders, which includes the mutual funds as well. So that dividend will be paid to a mutual fund too. So what will be the tax rate for that mutual fund? A very interesting question, though I don't know how much it matters to an individual who's taken a growth option in a mutual fund. But nevertheless, let's clear out Mr. Ajit's doubt. Uday, how would you help him out?
A very good question. So basically, mutual funds, the dividends they received are received on the behalf of the investors, and to that extent, the mutual funds would not pay any taxes on the dividend they receive. This is similar to the capital gains that the mutual funds make. So let's give you an example, and I'm just sort of explaining this slightly in detail so that it's clear. So when I'm investing in a mutual fund might be holding 10 stocks, and then let's say in one stock it has made profits and it wants to sell that stock and buy another stock. So when it is selling the stock, it makes capital gains. But because the mutual fund, the way it is structured as a trust, it does not need to pay any tax on those capital gains. I as a unit holder pay taxes only when I get out of that mutual fund. So in a way, a mutual fund is a very, very tax efficient vehicle for long-term investors. The mutual fund portfolio manager can churn the portfolio whenever he thinks a particular stock has done what it needs to do and move to another stock. The capital gains that accrue from selling one scrip and buying another scrip, as such, you don't need to pay tax, which if you were doing this on your own by buying and selling shares, you would actually have to end up paying taxes. So like in capital gains, so in dividend income, mutual funds won't pay any tax. So basically, for people, this is in some way like an arbitrage sort of a thing, wherein if you are buying stocks through the mutual fund route, you don't end up paying any tax on the dividend that you receive. So it's a good thing for investors who are investing in mutual funds, and generally so you don't end up paying taxes, which is a good thing. Yeah.
Okay. All right. Well, on that note, Uday, thanks so much for joining us on this edition of the show and talking to all of our viewers about the budget's impact on your personal finance, your wealth creation journey.